rename us. I think the name only shows my name.
Uh, I don't think I have permissions to do that. Let me see.
We need
Oh
Miles, huh?
no, rename. There we go. Oh, no, I can. Look at that. Uh, let's do Amanda and Matt. Hey, everyone, pretty good attendance so far. We are now live streaming to Facebook and YouTube. This is being recorded. I'm getting some audio feedback there. Opened up Zoom. Yeah, just take note. We are being recorded and live streamed, and we are going to have some time for questions at the end. We prefer those in the Q&A, but you are welcome to use the chat function to say hi. Let us know where you are watching from. And yeah, we've got a couple of people from the support team as well that'll be helping with Q&A. Otherwise, you can save your questions at the end and raise hands, and we'll start letting people come up on stage at the end and ask questions. But the Q&A function is there as well. So welcome. My name is Andrew. I am the Director of Product at Hospitable. I'm primarily focused on our direct booking side, which is, I would say, adjacent or not tangential, more closer than that for taxes. So the topic had come up, and Miles, our head of marketing, reached out to Amanda and Matt, our guests today, because we realized we had a lot of questions from hosts that we were not really equipped to answer, and they graciously volunteered to make themselves available. Yeah, so Matt, Amanda, they are managing directors of Keystone CPA. I'll let them introduce what they do themselves. They're tax advisors, tax consultants, investors, and authors. But in your own words, what would you say you guys do, and what is Keystone CPA?
Oh, well, first off, thank you so much for having us here,
Thank you.
Andrew. We are super excited. We have a lot of clients who use Hospitable and just absolutely love it, but this is our first time being on this platform. So I'm excited to share. My name is Amanda Hahn. I am a CPA and tax strategist. But I also tell people I'm an investor by night too. So like many of you, Matt and I also invest in real estate.
Yeah, I'm Matt MacFarland, also a CPA and tax strategist. Our firm, Keystone CPA, we're based in Southern California, but we work with clients all over the country. We specialize in doing tax planning and tax services for real estate investors. Kind of runs the gamut from people who are, just getting into real estate, they're working the W-2 job, just kind of dabbling their feet in investing to full-time investors, rental property owners, syndicators, fix and flips, all kinds of stuff. So that's kind of what we love to talk about. So we're excited to be here.
Okay, great. Well, I mean, thank you guys so much for making time for us and making yourselves available to our hosts. And just a heads up for people, this is primarily going to be U.S. tax content. We have an international client base, but most of our customers are in the U.S., and that's the focus for tonight's webinar. It's also focused primarily on income taxes. I think with Direct, we have a lot of questions about lodging taxes, pass-through taxes, sales taxes. I can make some comments on those. I can take some questions about those. I am not a tax expert, so I can mainly explain how Hospitable does taxes for our host. They're primarily coming into contact with those through our direct booking setup. So that's if you're not familiar, I think most people on this webinar probably host themselves and Hospitable customers, but we have two different strategies with direct booking. One is basic plan, and that means you are the merchant of record. So you are responsible for all of your tax registration and compliance and calculation. So you need to tell us how much to collect, and that Hospitable is not involved with the transaction. On our direct premium side, Hospitable is the merchant of record. So we are more involved in taxes on that side. We're helping you make tax calculations using Avalara as the service provider there. And at the moment, we are still collecting and passing through all of those taxes. We are in the process of filing and remitting on your behalf where we can, where we're required to, and where we have, starting from where we have the most hosts. So that is a process that is in progress. It's a big project, and it's a huge competitive advantage for us. So we are very much invested in doing this, but it's not live yet. So for at the moment, regardless of what direct booking solution, if you are using it with Hospitable, you are still responsible for your taxes, and they're all passed through. So that's how I think this topic came up. Is a few of our hosts, 37 to be exact, qualified for 1099Ks that came out recently. And this was something we weren't really anticipating on our side. This is our first year being live with Direct. And so we kind of started panicking. There was a Facebook thread about this. So yeah, only 37 hosts. because the income threshold for filing for those is still pretty high. It's, I think, from a COVID reaction, there was some easing up from the government. It's a $20,000 threshold, I think 200 transactions. So only 37 our host actually had those filed. Some of them might have had lower thresholds depending on your local registrations. So anyways, that's how we got into taxes. I know you guys are focused more on the income tax side than the lodging tax side, so I don't want to get too far off base. But we're going to go through some questions, and then anything you guys come up with during the session, raise your hand or jump in the Q&A, and we'll try and be helpful. But to kick us off, could you explain the potential challenges short-term rental hosts may face when dealing with these 1099-Ks that I mentioned? And particularly, I think there was some questions about accrual accounting versus cash accounting and the effects on tax obligations.
Yeah, I think for most, I know you brought up the whole 1099, so there's like a whole Facebook thread about it. And I think as investors, a lot of times people get really anxious when they hear that they're getting a 1099. So we get questions from clients all the time, not just from Hospitable, but if they have a property manager too, right? I mean, people will issue 1099s and they're just concerned, like, what does that mean? I really don't want a 1099. But the reality is the 1099 itself is simply compliance paperwork, right? So you are required, or Hospitable is required to issue a 1099 when the property owner meets certain thresholds. It doesn't mean you're paying any more or less taxes as a result of the 1099. The 1099 is just letting the IRS know that this money was earned. I think, alternatively, even if you're a property owner who didn't get a 1099, you're still reporting all the rental income you received anyway. So it's not like we were not reporting it. So it doesn't really matter from the perspective. I think a good practice point I would tell all of our investors is, if you are someone who did receive a 1099, you just want to make sure you send that to your CPA who's preparing your taxes, because at a minimum, what we want to do is make sure that the number you're reporting in terms of gross rents received matches the 1099 from Hospitable. And that's really just more of a way to minimize our audit risk, because if Hospitable said, hey, I collected, 40,000 on behalf of John Smith, and if John Smith's tax return says I, received 30,000, now you might get a letter from the IRS that says, hey, there's a difference between the two. But again, as long as your reporting matches up, there's typically no issues with that.
Yeah, we tend to like to stay off the mailing list of the IRS. So, but yeah, I think from a couple of things come to mind, for investors to kind of be aware of is, most individuals are cash basis taxpayers. So we get this question a lot. It's like, yeah, I got a booking in January, but they paid me, in December, and do I need to pick that up? And yes, you do, because that's when you receive the money. That's when you need to report it. Kind of works the same way too. Like when if Hospital is collecting on behalf of, and maybe not, I guess this is all a year-end issue, right? You collect stuff for investors in December, but don't pay it on to January. Maybe you don't do that, but a lot of times booking sites can do that. There's a lag in when they send the money to the property owner. But for tax purposes, the IRS looks as booking sites, property managers. You are agents for the investor, and so when you collect the money, is deemed. That's when it's deemed for the investor to have collected the money, because you're almost acting on their behalf. So it's important for investors to know that, hey, I didn't get my check until January from my property manager. Well, that's still income to you for December, because that's when they collected it.
Mm-hmm.
Yeah,
I do think that whether you specifically should be cash basis or accrual basis is an analysis to be done with your CPA. For many people, cash basis just makes more sense. It's easier from an accounting perspective. It's, cash in, cash out. But there are more rare instances where accrual basis could be beneficial. So there's not like a one size fits all, like everyone should be cash, everyone should be accrual. It kind of really is going to come down to the numbers. So that's where the fun is, right? That's where you can do some planning with your tax person.
Okay. And yeah, I think that's maybe where some of the surprises came with the 1099s from our side, is we didn't get to be involved in the choice of cash or accrual. Is basically the payment service provider that we work with did those as accrual. And we practice kind of a form of trust accounting on the premium side, is we don't pay out until the day after check-in. So yeah, there are people that had reservations that were booked in 2023, not happening until 2024. And those are held in trust until the reservation is checked in, and then we pay out. So there are people that are having to float a little bit of the taxes. And the other item I think is they do include the gross transaction value, which is not all of that is going to go to the host because we have a service fee embedded in that. So when they go to file and report their income, they need to be deducting what is the service fee that Hospitable kept. Yeah.
Yeah, and it's a common mistake we see with real estate investors, especially in the short-term rental space. It's just like you're saying, the property owner is saying, "Hey, Hospitable only gave me $10,000, but my 1099 shows 15." And the reason is because, well, there's these expenses that were paid out, and so when it's time to do your tax returns, you want to make sure we're reporting the gross, right? Because again, that matching, it's the gross is what did the guests pay, and then from there, though you deduct all of the expenses like the fees and all that kind of stuff. And so really important. I mean, at the end of the day, we're just getting to the same net number, right? You're only going to pay taxes based on the net profit you made. But doing the whole matching really helps you to stay off the IRS radar. And especially now with the IRS getting what billions of dollars in additional funding, it's really, really important for us to make sure all that matches. Because yeah, nobody wants to befriend the IRS unless you have to.
And specifically for Hospitable hosts, when you're going to report your net income, then you're going to get that data from your metrics reports. There's a reservation financials export, and you'll be able to then see what your actual accommodation revenue was. You'll be able to track what pass-through taxes were paid, and then you'll deduct that. So you never get the service fee, but that's reported in your 1099. So you'll need to go back and kind of look at what the actual revenue paid out was that's reported in your metrics on those reservations. Okay, so
Actually, I just was going to add because we're talking about reports, right? So I know Hospitable generates some pretty powerful reports. As property owners, it's really important when you're meeting with your tax person to not only provide those reports, because we all know there is a lot of different expenses that the owner will have outside of what Hospitable or any manager is making. So you will have your own cost to stage the property and property related things. You also probably have a lot of overhead expenses, like you going to a real estate conference or buying a book to learn about real estate, legal fees, CPA fees. So really important to make sure that you are tracking all those as well. And especially now that it's tax time, that you're providing those to your tax person. Because we see this a lot of times when we review someone's tax return and we'll literally only see property related expenses. And that's a telltale sign that they're not really taking the extra steps to capture all of their expenses outside of what the management type of reports are getting.
Yeah, that was a good segue. And I know, we wanted to definitely talk about, what some of those expenses are, what are maybe some of the common mistakes too of you talk about kind of underreporting your expenses, but also maybe over-reporting as well. What are things that people normally miss with expenses?
Property owners are pretty good, obviously, at capturing like the typical stuff, like the mortgage interest, the insurance, the property taxes.
Most are.
Most are.
Sometimes we see that and they're like, where's the mortgage on this?
I think it's kind of ones we see the most are excuse me, kind of those overhead costs, right? Like you've got professional development, you've got education, you've got
Legal
fees, you've got outside services, mileage, auto expenses. A lot of those I think are overlooked because maybe somebody doesn't know what they can deduct or don't have good record keeping, so they just kind of, or they think they'll get to it at some point in time, but lo and behold, 6 months goes by and we haven't gotten to it yet, and we don't have it recorded as an expense. So various reasons, but those are some of the big ones. Like home office, I think, is another one that we see missed a lot.
I mean, especially for people who invest in short-term rentals, we rarely see a client that goes out and rents a space just to manage their rental properties, right? So most people, when you're managing short-term rentals, you're just doing it from your home, right? And so if you have an eligible home office, definitely make sure you claim it. There are unfortunately still a lot of CPAs out there who say not to claim it because it's a big red audit flag. But that really hasn't been the case for, gosh, almost like over a decade. And in fact, the IRS has made it even easier for us to claim the home office deduction, where they're allowing a standard square footage where you don't even need receipts or anything, as long as you have, you have to truly have a dedicated home office space, of course. But they've made it easier for us to claim home office because they understand, right, that most people are working from home, especially when we talk about real estate investors.
Yeah, that's good feedback. And then yeah, you kind of got me thinking as well. Red flags, audits. So like best practice on like make sure you're doing good documentation and record keeping. How long you have to preserve that for? What's the kind of common stuff that we miss on that?
I think it's always like sexy to talk about tax savings, especially for people in the short-term rental space, because that's like one of our favorite tax loopholes when it comes to real estate investing for people who have high W-2 income, but also investing in short-term rentals on the side. And I'm sure we're going to dig into that short-term rental loophole. But I think the less sexy part of this whole tax conversation typically is the bookkeeping side, right? Bookkeeping,
Yeah.
like, do I really have to do that? Hospitable's giving me the report. So we already talked about it. You got to have still additional bookkeeping so you track all of your expenses. Receipts, do I really need to have receipts? Unfortunately, the answer is yes. Your receipt is ultimately going to be your insurance if you were to get audited. And especially on things like that are not really clear, whether it's business or personal. The example that comes to mind often is Costco, right? So you might go to Costco where you're buying supplies to stock your short-term rentals, but you might also be going to Costco to buy baby diapers. And so it's really important to make sure you have receipts for that because that's what's also always going to demonstrate to the IRS what exactly you purchased at Costco. So people always ask like, hey, there's a credit card statement showing I paid X dollar amount to Costco. Typically, that's not going to be sufficient because the IRS is not going to be able to tell what it is. So that's something definitely to make sure you keep from an audit protection perspective.
Yeah, I think from a time perspective, most people need to keep copies of receipts for 3 to 4 years. So the IRS statute is 3 years, but some states, like here in California, the statute is 4 years. That's for the everyday general stuff. But if you have big ticket items like bought a property, sold a property, other things like that,
Improvements.
improvements, you want to keep those things probably indefinitely while you own the property, because they can always in some way or another ask you about things like that. But with receipts, I mean, the best practice nowadays is just you don't actually have to, this shouldn't be eye opening to anybody, but you don't actually have to keep the physical receipt anymore. Obviously, you can take a picture, scan it, put in your folder, have your assistant put in your folder, February, March, that's probably best practice. I'd say keep up with the accounting and bookkeeping, as I mentioned earlier, like sometimes people kind of don't do it for 6 months, but you know, think about it, we're in March right now, right? Like I'm gonna say like big businesses, right? They're doing their financials every month. So, if your financial statements aren't done for last year yet for your rentals and things like that, that's a practice you should improve upon, right? Because you should be finishing your December financials in January every year. And it should be a seamless process to kind of hand it over at that point in time, theoretically.
Do you have any software you like to recommend for that? Is the topics coming up in chat right now? People talking about QuickBooks, Stessa, Wave.apps.
Yeah. I think people always ask us that, like, what's our favorite? And what I always rephrase the question in that the best one methodology is what works best for you as an investor. So the answer might be different from one person to the next, right? If you're someone who's really pretty good with technology, which I think most people here are, if they're using Hospitable, pretty tech savvy people, then QuickBooks is probably I don't know, the most widely used one because it, interfaces with your bank and credit card and just a lot of the automation can be built in with it. But again, it is a form of technology, so you just got to make sure you take the time to learn it and utilize it correctly, or you have a bookkeeper to help you do it. We do have clients who use Stessa as well. Stessa, Zero, a lot of property management type of reports, right, that you can export to Excel. You can even use that. So let's say I have my Hospitable report, I export to Excel, and then I just build upon that. So I consolidate that number alongside my own numbers of, travel, legal, tax, accounting, and all that good stuff, and add them in to create the whole picture for my tax person. So we love QuickBooks. We use QuickBooks ourselves. A lot of our clients use QuickBooks, but that's not the one and only option. You just want to find an option that works well for you because ultimately you're the one who has to be comfortable using it and tracking it.
Okay. Circling back a little bit, we talked about documentation for an audit and whatnot. There's a specific topic I think that we've seen in the news a little bit. There's been I think some maybe some court cases or audits about the definition of active versus passive income as it applies to short-term rentals. Are you guys able to comment a little bit on the context there and what's good for hosts to, if what documentation you need if that is ever challenged?
Yeah. I mean, I think what I love about the short-term rental space is that it really helps investors to use rental losses against W-2 and other income, right? When it's non-passive. So just to take a step back, for people who invest in long-term rentals, and if you have higher income, let's say $150,000 or more of total income, let's say from a job, it's often very difficult to be able to use long-term rental losses against that W-2 income, unless if you happen to also qualify as a real estate professional or you have a spouse that qualifies as real estate professional. And because a lot of our clients are high income earners or people with businesses outside of just real estate, if they're just investing in long-term rentals, they end up having a lot of passive losses, which is not the end of the world, right? We can use it against future passive income, but we don't get to use it to offset W-2 income immediately. And that's where the short-term rental loophole comes into play.
Yeah, so with short-term rentals, it's the threshold in order to be able to treat your rental losses as, we call it active or non-passive and deduct it against W-2, a lot easier than it is for long-term rental investors. And again, I guess taking a step back, when we're talking about rental losses, we're not talking about that you're losing money. We're talking about strategic losses through maximizing depreciation, some other tax strategies like that. So if we can create a loss, how can we use that loss to offset W-2 and other income? So for short-term rental investors, in order to do that, they have to meet one of the they call it the material participation test. There's 7 of them, but really 3 of them probably apply to 99% of the population out there. First one is they need to spend 500 hours a year working on their short-term rentals. And this can be one rental, this can be multiple rentals. It's not 500 per property. Think of it just kind of you're doing a lot of the self-managing, the day-to-day stuff. Now, if you can't get to 500 hours, the next tier down is did you spend at least 100 hours? And it's more time than any other person spent on your short-term rentals. So if you have 150 hours, then I don't know, you had 3 properties and your general contractor worked on all 3 and he has 140 hours and that's the most, then you've met this test. And if you can't get to that tier for some reason, then it's any number of hours you spend, as long as it's more than the total hours everybody else spent on your short-term rentals, then you can qualify. So there's different ways to do it. For our clients, it's a lot of our clients who are, maybe full spouses working full time, they already able to use their short-term rental strategy to kind of create strategic losses to use it to offset their W-2 income, because those thresholds are not as great as having to be a real estate professional.
Yeah, I think when it comes to documentation, from an audit protection perspective, it's really important to make sure we document our hours. In the U.S. court system, right, most people, when you're, charged with a crime, right, we're sort of innocent until proven guilty. But when it comes to taxes, it's actually the opposite. So we are guilty until proven innocent. In other words, if we say we are treating our rentals as non-passive, we have to be able to prove that we actually spent the hours, we actually did the right things. And that's where documentation comes in. And if you are like me, it's hard for me to remember what I did 2 weeks ago. And so if you think about being audited on what did I do for my short-term rentals 2 years from now, 3 years from now, probably impossible for me to remember, March 10th, what did I actually do? And that's where documentation comes in. What we recommend for all of our clients who are trying to use the short-term rental tax loophole is to have good documentation on what they did, which property, how long was it for, and really to have documentation surrounding that. In fact, one of our clients created an app to help track hours on short-term rentals. It's called Reps Tracker, so you guys can check it out online. Or you can go to keystonecpa.com/app, and you'll be able to access that as well. So definitely make sure to track your hours if you're trying to use that loophole.
Okay. Yeah, we've talked about the idea in Hospitable about, kind of like doing a tracker of trying to estimate the amount of time, even when, we're kind of like automating your communication, that's still kind of time spent managing. So we've toyed with the idea of, can we give our hosts an automated time tracker of how much time they spent managing their rentals on the software that could complement any documentation that you have for material participation. Haven't done anything with it yet, but we're thinking about it.
I love that idea. I think that sounds like there could be a good collaboration, right, with the existing app to be able to do that.
Yeah,
What I love about Hospitable is that it really helps to simplify, because so from our end, we talk to clients and say, hey, you made 300,000 or 200,000 from your W-2 income. We want to pay very little taxes. One of the solutions is short-term rental loophole. Inevitably, people are like, well, I don't want to self-manage. It's so crazy. How am I going to do
yeah,
that? So I love that Hospitable is such a great way to allow people to really do that on a more efficient way. And in terms of time tracking, I know you're able to allow the host or the property owner to be able to kind of delegate, right, when things have to be done. One of the requirements, like Matt said, was you spend at least 100 hours, and that's more time than anyone else. So if there's a way to be able to also track how many hours our cleaning crew or repair guys
yeah.
are spending, that's going to be phenomenal because that is one of the requirements from an
Yeah.
IRS perspective.
Yeah, it's
So
definitely
love
something that we have access to, in a programmatic way and could do some neat things with for reports for that. So yeah, that's a good idea. Someone's asking in the chat that is the tax loophole only work for property owners or properties that you own? I'm a property manager and I wanted to know if that benefits us.
Okay, so the question is, if I don't own the real estate, but I manage property for other people, is that
Yeah,
still beneficial?
that's
Yeah, I mean, possibly. I think, earlier Matt had said the strategy is around creating tax losses and
yeah,
using that to offset W-2 and other income. And the tax loss we're talking about, besides, car, home office, paying your kids, the biggest piece of that is depreciation, right? So we own a property, we're taking depreciation. Right now, we have bonus depreciation. So that's good. So the depreciation piece of the real estate is only available if you are the property owner. But outside of that, if you're managing for other people, you can still use the same loopholes and strategies. You just might not have that big depreciation if you don't own the actual property.
okay. Cool, thanks. Yeah, there's actually some pretty good chat going on about that. So it seems like something that people are interested in and maybe weren't aware of before. So thanks for the explanation there. Um, Jumping around the theme, cancellations. So we talked about we got started on the 1099 topic, and I think this is very relevant for people doing their local tax filings for like lodging and sales tax, which are often on a monthly basis, not an annual basis. So you will frequently, if you're having to do that, have something you've already reported income on, and then have to come back and make a cancellation. I know you guys aren't super familiar with that area, but in general, how does someone go about cancellation on reported income that they've already declared?
Yeah, I mean, if it's something that you've already you know, again, best scenario I can think of is like year end, right? So you
Yeah,
picked it up in December, but they're not going to stay until January, and then comes January, they've canceled. You got to give the money back. It's going to be a timing issue, but you're going to pick it up in income one year. The next year in January, you're going to just basically reduce your income by that amount that that you had to refund to the client. So that's definitely, deductible. That you're not going to have to report and pay tax on it at the end of the day. It's just going to be split over 2 years, I think.
Yeah. I mean, the good part about it is the IRS is never gonna force you to pay taxes ultimately on money that you refund.
yeah.
So it's just a matter of that then later becoming a deduction against income in that specific year.
Okay, cool. When dealing with multiple short-term rental properties, what are the considerations for host in terms of consolidating income and expenses for tax reporting purposes?
Do you want to take that one?
Well, I think there's, generally speaking, from a tax perspective, the IRS likes to see each property broken out on the tax return. So it's an individual return, it's a Schedule E. If it's a partnership return, it's like a Form 8825, but they have columns for each property. That's a general way of doing it. That makes it easier to track income and expenses by property. Also easier to track depreciation by property because typically a lot of people are buying the property simply. I'm not buying all 10. I'm not buying 5 short-term rentals in one transaction, right?
Mhm.
Now, if you're getting consolidated reporting, can you put all your properties together as one on a tax return? You could. Probably need to do some sort of grouping election of your return to kind of get there. Is a best practice. I would split it out and show it property by property, but
Mhm.
if somebody can't, you could definitely file a return that way if you
Well,
had to.
and I think outside of taxes, just best practice from a management perspective, right? As a property owner, I certainly want to see profit and loss by property. So I know how each property is doing. So I think we rarely, if ever, have a client provide us consolidated financials, just lump sum across all rental, right? Because you're already tracking it property by property too.
Okay. I think that's the end of our scheduled agenda. I'd like to ask you, is there anything that we missed? Anything that you've got on the tip of your tongue right now that you'd like to share with us?
I'm sure we'll get to it with through the questions, but I think, as short-term rental investors, it's really, and especially those of you who are operating, through Hospitable, I imagine we have a very high percentage of people here in this specific audience who can create some pretty massive tax savings by using, cost segregation and all that, and truly offset taxes from W-2 income. But I will say that the short-term rental tax loophole is probably one of the most uh, common mistake areas that we're seeing, not from the investors, but from CPAs. Because you're not going to find a lot of CPAs who specialize in real estate. And short-term rental is kind of another specialty within real estate itself. And so we unfortunately have come across investors and even CPAs who say, oh, well, it's great you have a short-term rental, but you're not going to be able to use it to offset taxes from W-2 income because you're not a real estate professional. And so if somebody is telling you that, make sure you talk to another CPA. Because if you heard nothing at all from today, the key thing to understand is you don't have to be a real estate professional to use short-term rental losses against W-2 income. It's possible for all types of investors, even if real estate is just your side hustle.
Okay. So is this what people are referring to as the short-term rental loophole? Is that cost segregation? Is that the concept?
I mean, cost segregation is one piece of
It's
it,
one piece.
right?
Okay.
But yeah, the short-term rental loophole basically says, if you strategically create tax losses, I don't want that loss to be trapped in the passive bucket. I want that loss to
Okay.
actually be used today to offset taxes from my W-2 income. And if for any of, if any of you, for any of you, if the short-term rental loophole is something new to you, or if you have been told you can't use it because you're not a real estate professional, you can go to our website at keystonecpa.com. We have a free downloadable tax savings toolkit. Part of our toolkit, we have like a 30-page detail just about the short-term rental loophole
Okay.
specifically. So check that out.
Wonderful. Thank you. So yeah, we're going to open it up for questions. People are welcome to raise their hand to get up on stage. We've also got a lot of Q&A, so I'm going to kind of go through some of those until I see someone. We had Lisa asking how many transactions trigger the need for a 1099-K. I think the answer is it depends. The federal threshold for 2023 was $20,000, and I think 200 transactions. Is that correct?
Yeah, that's our understanding.
Yeah.
Okay. Yeah, and then I think the minimum threshold you might see, depending on your jurisdiction, is $600. So yeah, you need to obviously double check everything we tell you here, but that's my understanding from our experience working with 1099s this year, and that threshold is subject to change. I think this was even like a kind of a last minute November action by Congress to keep the COVID level extensions on that threshold. So 2024 might be completely different.
And especially with an election year coming up, that's big. Taxes are going to be on everybody's mind in the next, 8 to 10 months.
I don't know about everybody's would be on our mind, but
Okay. We've got a question from, I hope I'm pronouncing this right, Jody, who is a co-host based in Calgary, Canada. Ooh, this is going to be tough. I receive payments and taxes from owners, which I settle on a monthly basis. Should I remit all the taxes I've collected to the CRA, or should I return tax amounts to their owners? Is this something we can't answer?
I'm not familiar with Canadian tax law, unfortunately. So,
I don't know if the question is whether we should remit it to the government or remit it to the owner. Is that the question?
Yeah, should I remit all the taxes I've collected to the CRA, or should I return the tax amounts to the owners? I see payments and taxes
if you're withholding or collecting on behalf of property owners,
And you're filing the tax return on their behalf, typically you would
submitting money,
remit it.
then yeah, you would remit it. But
Yeah.
if you're just a pass through and you're not actually
Yeah.
remitting anything else to the government, then you would obviously just pass it all to them. But
Yeah, I mean, typically the remittance to the government will coincide with some sort of form. So maybe the answer will be depending on as the co-host, are you actually filing those forms or not? If not, I imagine you're probably going to remit it to the host, I mean, to the owner, so the owner can file the return and, remit the cash.
Okay. Are you all familiar with the hotel business rule? Is that?
Hotel business. So it depends on, so in the tax world, there is a different types of tax treatment when you operate your Airbnb, similar to the way a hotel works. And so there's a lot of disagreement in the tax world among CPAs on how do you actually report short-term rental income. Some CPAs will say you put it on Schedule C. Some people will say you put it on Schedule E. And so the difference between the two is that if you put it on Schedule C, typically that means you're going to also pay, in addition to federal and state income taxes, you also have to pay self-employment tax. And Schedule C basically is where we say this short-term rental is not like any other short-term rental. It is being operated similar to how a hotel works. So meaning it's not just the guests come in and then they leave. When they're here, we're offering a lot of additional services. So like daily cleaning, we might have airport pickup and hotel drop off and all that good stuff. And so that's where, if you're operating it like a business, then you're subject to additional layer of tax, and that's typically where that comes in. I will say, in all of the short-term rental investors we've worked with all the years, we've only had maybe one or two people who rose to that level of a hotel business, but most people are able to fly under the radar and not have to worry about that additional layer of tax.
Okay. Thank you. And in the audience, I don't see anyone raising their hand yet, but if you do have a question, I'm seeing a lot come through chat. I can't keep up with those. So please use the Zoom Q&A function if you want us to take your question live, please. Oh, we do have a hand raised. Look at that. Ryan, I'm going to allow you to talk. So you're on stage. Please unmute yourself and let us know what your question is.
Hey, Amanda and Matt, thank you for coming in. I have a question. So for professional training or books, study or bigger pocket subscription, stuff like that. But if I have multiple properties, when I file the P&L for them, do I just put those fee expenses on just random one and call it, or it has to be under like general? Because I use that knowledge to apply to all of my investment.
Good question.
I think best practice, what I tend to recommend is from a financials bookkeeping perspective, maybe have a separate column that you're tracking your overhead expenses for. And then when it gets to tax returns, you've got your total of your overhead costs, various different categories where it adds up to, $10,000. Then you split that among the various properties you have. And on your tax return, you have a expense for property number one called general overhead costs, $1,500. Property two, same thing, $1,500. That way, it makes the reporting a little bit easier from a tax perspective. So have a separate column for bookkeeping and financial statements, and then just split it out among your property on your tax return.
We also have seen where, if you have a property that has very high income, you just bury all those overhead against that property instead of allocating it amongst, the 3 or 5 that you have. I mean, ultimately, it doesn't matter, right? Which method you choose, ultimately, it doesn't matter because they will all end up as part of your overall net profit or loss on the tax side of it when it's all said and done. So it's just more presentational in terms of, how you and or your CPA wants to show that. And we've done it differently for different clients depending on what their preferences and how they keep their books.
Copy. Thank you very much. And I assume that applies the same for like air ticket and like meal conference and stuff like that, just like divided it equally over across the portfolio.
Basically expenses that are not specific to a property, right?
Like overhead stuff.
Yeah.
Right. Thank you very much.
Cool. Thank you, Ryan, for the question. I'm going to put you back in the audience. Okay, let's see. How do I do that? How do you take off stage? I don't see.
We have
You
like
might just be on
70
stage
some
now.
chats.
Yeah,
Ryan's going to present with us.
Let's pull Paula on stage now. And Paula, you are on stage and you can talk now.
Hi, my question is, my husband owns a property. I manage the Airbnb and I have a real estate license as well. We file our taxes joint.
Sorry. Sorry. I think I messed up, Paula. Hold on.
Always happens right when they get to the question part.
Yeah, sorry.
I think I saw her.
Sorry, Paula, you've been muted.
I saw her question in the chat
Okay.
actually. So,
Yeah. Sorry, Paula,
let
you're
me
back
read
on.
it.
That's my mistake.
Oh, okay, she's back.
Yeah. So it is in the chat. Basically, do I need to add my name to title to be able to write off the mortgage as an expense for the Airbnb?
No, you don't. So if you guys are filing a joint return, you don't need to be on title. You're gonna just report all that income together anyway.
Okay, great. Thank you.
Thank you, Paula.
Yeah. And earlier we talked about the short-term rental tax loophole, right? Where if you have enough hours, you can use it against W-2 income. That works the same way where if let's say Paolo is the one doing all the real estate, earning the hours, the husband is just working W-2 job, that's perfectly fine too. Title doesn't really make a difference. We're just looking at, as a joint married couple, how many hours are you spending and what are you doing with respect to the properties?
Okay, I'm gonna pull the next one on stage here is gonna be Nico. Nico, you're on stage if you want to unmute and ask your question.
Hey, Amanda and Matt, this is Nico in California.
Hi, Nico. Oh,
How you
Nico.
doing?
Nico's our client. Hi. Can't
Hi.
see your face,
So-
but
Yeah, so I have a question just a little bit different. So I have a short-term rental and I live in California and I installed the solar. So, and I got 30% of the federal tax. Can I write off the whole thing or is that carry over if I don't use it for this year? Thank you.
The
Solar?
solar credit?
Yes.
That is a good question. I believe the answer is yes. Don't quote me on that 100%. But I believe the credit, if it can't be used altogether, I do believe that credit carries forward. But
yeah, I mean, I know it's 30%. That's one of those things that they keep changing the law on as well. But yeah, I agree. I think I'm pretty positive that it will carry over, but we'll send you an email because I have your email.
Okay, thank you.
Thank you, Nico. Okay, I'm going to take one more from the Q&A and just kind of go back and forth here. We got a bunch of hands raised. I'm sure we're not going to have enough time for everybody. I know these are great. For purchase of houses used in conjunction with STRs, is depreciation 39 years rather than 27.5 because it qualifies as commercial rather than residential property? Wow.
Yeah, that's a technical question, and in fact, there's not a wide agreement even amongst CPAs. So, but I'll tell you how we treat it. We typically treat it as 39 years as commercial real estate, and that's just on the building itself. So if you do a cost segregation, right, for your short-term rental, you're going to do accelerated depreciation where a cost segregation study will even break out the components of that. You'll still get probably a very large tax benefit through your furnishings, your fixtures, specialty plumbing, and all that good stuff. So, but yeah, we treat it as 39 years commercial real estate.
Okay. I'm going to pull another guest on here. Rajni, you're on stage. Please unmute yourself.
Hi, Amanda and Matt. Thank you so much for coming on stage and helping us answer our questions and giving information. So we just started with the our first short-term rental, and I just want to know, about bonus depreciation. Me and my husband, we both are high W-2 income people, but we don't know how much we'll be able to offset. I think the taxes for the next year.
yeah, that's gonna be have to kind of exercise or calculation you'll need to work through with your tax preparer, your tax accountant. It's not a one size fits all for every property, unfortunately. There's a lot of different things that come into play, but I mean, part of it's going to be depend on purchase price. Part of it's going to depend on where you bought the property, because when we do depreciation, you have to split out the purchase price between building and land, and some areas have more allocated than land than others, and so that's why there's a lot of different moving pieces.
Yeah, what I would say is you probably want to do some planning, right? Because first off, you want to make sure you're doing the right things during the year to meet material participation. And so you and your husband, both of your hours can be combined together to count towards that. But nonetheless, you have to make sure you meet the hours first. Once you can confirm you've met the hours or that you will meet the hours, then the next step is to work with your tax person or a CPA or us to look at a estimate of a cost segregation study. So that's where Matt was talking about. We can get an estimate to figure out what do we think the tax depreciation is going to be? And then from there, you'll be able to know how much taxes you'll save. And that's important because you don't want to overpay the IRS, right? Right now, you're probably withholding at a pretty high rate on your W-2 income. But if after you've taken the first and second steps, and you realize, hey, I'm going to get a $100,000 loss or a $200,000 loss, well, then what you should do is immediately change your W-2 withholdings at work so that you don't end up with a huge overpayment next year and get yourself into, overpaying the IRS.
Especially with interest rates are like what they are right now. Thank
Not
you.
interest rates, it's almost free.
Did that answer your question, Rajni?
Yes, thank you.
Thank you so much. All right, I'm going to jump back into Q&A real quick. I'm going to combine two here. Questions on expenses. Is the time you spend driving to your short-term rental properties, is that part of your calculation of, I think, material participation? And as far as documentation of your time, is Excel okay? Or is there something, a higher expectation of clarity and time tracking?
I guess let's start with the second one. So from a time tracking perspective, Excel is definitely fine. We mentioned that app earlier, Reps Tracker. But again, I would just encourage people to kind of use the method that you know you're going to stick to. So if you're somebody that likes to use paper, then by all means use a paper log. But if you like Excel and you hate apps, then use Excel. But it's just got to be consistent, be as detailed as possible. I'd say we come from the accounting world, like Big Four accounting world. We have to track our time in every 6 minutes. So that's what I default to. But I mean, maybe other people may not. But I'd say be as, everything doesn't take 2 hours or 1 hour, right? Things take 1.2 hours, 1.25, so.
Yeah. And I will say on the time tracking thing, you track it to the level of detail where it's easy for you to recall what you did and how to prove it 3-4 years from today, right? Because that's what's going to happen. If they're going to audit you, they're going to say prove this date and this date and this date. So that's what really it's designed for.
And then on the question of the travel time, like driving to and from properties, this is one of those things that's probably a gray area. You probably get different opinions if you talk to different CPAs. We are of the opinion that if you are driving to a property you're going to work on it, you're going to fix it up, the time that you're going to spend there, it counts as material participation. Then it's our opinion that the drive time to and from will count as material participation. Having said that, if you are, we mentioned one of the material participation tests was 500 hours. If you're trying to get to the 500-hour test and, you've got 100, you don't want the travel time to be the thing that pushes you over and gets it taken, So keep that in mind that you don't want it to be a huge chunk of it, obviously.
Yeah, and I'll just add, not all drive time will count. Like Matt said, driving to do material participation activities should count. So conversely, if you're driving to a real estate conference that's not material participation, then those should not count either. So looking at driving for what purpose.
Right.
Okay. Yeah. And good general feedback. If your lawyer or accountant is billing you by the hour and not by a smaller unit of time, you're probably getting ripped off. I'm going to pull someone else on stage here. Jean-Pierre, you are on stage.
Hi, you guys hear me?
It's a little rough, but go ahead.
Okay, just I'm a high W-2 earner, income earner. I just wanted to see, once I do the cost segregation study and I qualify for material participation, right? And with 80% bonus depreciation, right, last year, what should I expect in terms of offsetting those losses against my W-2 income? Is it like, should I expect some sort of a refund, or those losses are carried over to the next year?
Yeah, so it's a great question. So it's kind of around, basically all encompassing short-term rental loophole, right? So I'm going to change the order of those steps just for your benefit. So you mentioned doing cost seg, making sure you got material participation. You want to make sure you get the material participation hours first. You met the test before you pull the trigger on the cost seg. Because if you don't meet the material participation requirements and you do a cost seg to generate a bunch of depreciation and creates a loss on paper, that loss is likely going to be a passive loss and trapped as a passive loss going forward. So you wouldn't even be able to benefit from the strategy. So you want to make sure you meet the material participation test. Then you can do a cost seg. In a perfect world, a cost seg is creating a loss on paper for your rental. You're going to use that loss to offset your other income. That loss is basically the way you would think about it is if, I don't know, let's say the loss was $100,000 and you were in a 40% combined federal and state tax bracket. That $100,000 loss should save you $40,000 in taxes that you otherwise would have been paying on your W-2 or other income that you have. So hopefully that kind of helps, frame it a little bit better.
Yeah, and I think what we said earlier, right? Once you know you meet material participation, then step 2, get an estimate of the cost like benefit, then change your withholding so that you're not overpaying during the year.
Thank you. That's the step that I need to do, I guess, for this year, change my withholding. So that's like.
Yeah, and just so something not really specific for this question, but something just to bring up for everyone. We talked about bonus depreciation. So the current law is we have 80% bonus depreciation for the 2023 tax year, the return that you're about to file. There is legislation going through Congress right now, already approved by the House, now waiting for approval from the Senate. And if that law gets passed, it is designed to bring back 100% bonus depreciation for 2024 and 2025, but also retroactive to 2023. So for those of you who are short-term rental owners looking to use the short-term rental loophole, or even just short-term rental owners in general, consider waiting to submit 2023 tax returns until we get more clarity on whether that law passes. Because if it does, it could be very, very beneficial for even the 2023 tax return.
Okay, thank you so much, Jean-Pierre. Very, very basic question in the Q&A, but we're investors. We're expecting our assets to appreciate, but we're marking down depreciation. How does it work to take depreciation? Okay, the difference between those, but is there a consideration for expensing depreciation and then an eventual sale of that property, recognizing a profit on that? Is there any consideration we have to make when we're doing that?
Yeah, great question. I think so the beauty of depreciation is the IRS, or the tax code rather, allows you to take depreciation because there is an assumed wear and tear on the property. So we're allowed to take depreciation regardless of whether the property is appreciating in value or not. It's basically the law. You can write it off over several years, right? So that's why it's there. And in fact, it is a requirement. So sometimes we've seen bad advice from CPAs who say, don't take depreciation because later you're going to have to pay more taxes or recapture it. Even if you don't take depreciation, if you're audited, IRS is going to treat it as if you already took it because it is a requirement. So going to your question about the eventual sale, yes, when we take depreciation, what that means is we're writing down the purchase price of our property. So eventually when we sell it, we'll have a larger gain, right? Because we can't write off our purchase price twice. But there are a lot of ways to defer the taxes eventually when you sell. One of the most common ones is 1031 exchange. So I have a couple short-term rentals right now. I take all the depreciation that I can. When I sell in a couple years, maybe I can 1031 exchange into a motel or a hotel, or just even better short-term rentals. When you follow the rules of the 1031 exchange correctly, the result is there's no depreciation recapture. You get to kick the can down the road. Kick the can down the road indefinitely into the future.
That sounds lovely.
Yeah, that's lovely. It's not available for Andrew as a US thing.
Yeah, well, I'm a US citizen. I just happen to live in Italy. Okay, let's bring in someone else on the stage here. We've got about 5 minutes left. We'll try and get a few more in here. So Russell, you are now coming up on stage. If you can unmute yourself. Hi, Russell. We can't hear you, Russell. Okay, I'm gonna
to say that the federal credit for solar is extendable over multiple years. I helped write it during my time in Congress, so bit of an authority on that one.
We missed part of that, Russell. Can you start over, please, with your question?
Yeah, sure. Congratulations for buying solar panels and doing your part to save the planet. Those tax credits are extendable into future years and can be saved for when you have more tax appetite.
Thank you.
Thank you.
Did you have a question as well?
No, just wanted to clarify that.
Cool. Thank you so much.
Thanks, Russell. And I think Russell said he works for Congress.
Yeah, we got a prestigious audience.
Awesome.
Great.
So can we get 100% bonus depreciation back, Russell?
We've got some jobs for you.
We need it tomorrow.
Let me pull him back on stage. We can grill Russell now.
Yeah. Oh, and I was just gonna say, going back, I forget the gentleman, I think the question about the bonus depreciation. So for those of you who've already invested in short-term rentals, if this is the first time you're hearing about bonus depreciation, cost segregation, you can absolutely still use that strategy now when you file 2023 tax returns. You don't have to use it in the first year of buying a property. You don't have to use it immediately. You can use it anytime when you own a rental. Just make sure to check with your tax person that it will benefit you before you pay for a cost segregation study.
Yeah, we did have a relevant question here. Sorry, I pulled you on stage, Priscilla, but if you can wait just a moment. So Lisa was asking, if I'm taking bonus depreciation year 1, is there also much benefit in year 2 and beyond? I'm operating a loss right now, and I'm wondering if it's worth to continue.
It's a great question. So typically in years, after you've taken, done a cost that generated a bunch of depreciation, you've created a big loss in year 1. Year 2 and thereby, you're still going to have some depreciation, it's just not going to be as much. So it's less likely that you're going to have a loss. Obviously, if the property's stabilizing, we all want short-term rentals to be kind of cash cows, right? So less likely you're going to have a loss in subsequent years. So if you don't have a loss, it's not as important to try to meet the material participation requirements. But what some of our clients do is in year 2 or subsequent years, they've stabilized that property. That one's kind of a cash cow. It's going to show profit on paper. They'll start buying other short-term rentals and focusing their time on the new short-term rentals and do cost seg on those to generate losses on those and kind of keep the ball rolling, if you will.
Yeah. Okay. Priscilla, you're on stage. If you can go ahead and unmute yourself.
Hi. I was wondering, what's a creative way to legally deduct all your personal expenses into business deduction?
Oh gosh, that is a great question. What is a creative way to legally deduct all personal expenses? I think my short answer is there is no such thing. If you look at the tax law, basically the tax law is a set of incentives where the government wants us to do certain things. Start businesses, invest in real estate, save towards retirement, and all that good stuff. There's not really an incentive for us to live like lavish lifestyles. And that's why you're saying like, hey, when I spend money on my kids or I do all these other things, it's not really a tax deductible item. But I also wouldn't worry so much about writing off every little thing personally, because again, odds are it's not going to be legal. But when you are spending something on things that are more significant, always ask yourself the question, how can this turn into a legitimate business deduction? And we talk a lot about, kids typically when we teach, because kids are very expensive, right? So if we just give money to our kids, it's not a tax deduction because it's just our kids and we love them and we like good stuff. But if we instead said, how can our kids help out in our real estate business? Let's say our kids are helping with Airbnb turnovers, for example, or helping us with Excel in bookkeeping. Now we can pay them for the work they're doing in our business, and that turns into a legitimate business deduction on our end. Up to the first 13,000 of income that the kids earn could be completely free of income taxes. So that's just one example of how you can, strategically turn personal expenses into business deductions. But there's not a way for us to have this blanket statement like, I'm just going to write off everything under the sun, unfortunately.
We are being recorded, so it's good. Good advice.
And we had a member of Congress on it.
Yes. Thank you, Priscilla, for the
We're live on
question.
Facebook.
Thank you.
Okay, last question here. I'm going to pull one more on so we don't abuse your time. But Owen, you're the last question of the evening or the morning. Sorry, depending on where you are.
Yeah, can you hear me?
Yep.
Hey team, way to thread the needle on that last question. I loved it. So yeah, Owen in Denver, Colorado. My question is around kind of LLC tax structure. So do you need to have an LLC to take advantage of the Airbnb loophole? And maybe an add-on to that, what's the ideal structure for managing multiple STRs, assuming you have a W-2 job?
First off, I'll let Matt answer the question, but I just want to say Denver, Colorado, we're going to be speaking there at the short-term rental summit for Tony Robinson. I don't know exactly when it is, so we'd love to meet you there in person.
Yeah, but to your question, no, you don't need to have an LLC to take advantage of the short-term rental loophole or, in fact, to be able to deduct any expenses. You just need to have a business. And owning rental properties is a business in the eyes of the IRS. So we get that question a lot. It's a misunderstanding that people think they need to have an LLC or a corporation or something to be able to take tax deductions. That's the farthest thing from the truth. In terms of kind of what's the best entity structure to kind of run your business, if you want to hold title to real estate, for the reason you might do that is, have an entity to hold title to real estate might be from an asset protection standpoint. Typically, what we see the most is using LLCs to do that, to hold the title. Now, actually, if you're running like a real property management business, that might be something you kind of want to run through like an S corp. But again, this is not a one size fits all. I would say talk to your tax advisor about that.
Okay. Thank you. Thank you so much, Owen, for the question, the last of the evening. Thank you so much, you guys. Amanda and Matt, thank you for your time. We generated way more questions than we have time for. But that was kind of the point. I think we gave people a lot of food for thought, topics they can continue researching and looking into on their side. Shared your website in the chat just to make sure everyone has it, KeystoneCPA.com. Where else can people find you? I think you guys have a podcast, you have books. Make a last plug here as a thank you for your time.
Yeah, we actually don't have our own podcast, but we love coming to platforms like this where we can just educate as many people as possible about the tax benefits, and love, short-term rental tax loophole is one of our absolute favorites. We're all over social media in terms of LinkedIn, Facebook, but I think the best place to find me is probably on Instagram. If you're looking for daily tax tips, I talk a lot about short-term rental loophole there as well as Amanda Hahn CPA.
And I'm not as frequent on Instagram, but sometimes she'll let me in the background of her videos. So
he's usually blurred out.
Yeah. Okay. Thank you so much, guys. We'll let you go. Appreciate so much for your help.
thanks, Andrew. Thanks, Hospitable.
Yep.
Yeah.
Bye-bye.
Thank you.